All right, welcome to the Explainer. You know, whenever the world's most famous investor makes a move, everybody pays attention. Well, Berkshire Hathaway just dropped its Q2 2025 portfolio, and wow, it tells a really fascinating story about where the smart money is headed. So, what's the Oracle of Omaha thinking? Let's dive in and unpack this thing.
You've probably heard this quote 1,000 times, but let me tell you, this isn't just some old saying. It is exactly the playbook he's running right now. This one idea really sets the stage for everything we're about to look at. He sees fear in certain parts of the market, and you better believe he's getting greedy. So what's the big story here? Let's not bury the lead. What the filing shows is this really clear, calculated pivot. He's trimming the popular, high-flying stocks, yeah, I'm talking about tech, and he's taking that money and plowing it into these overlooked, undervalued companies. You know, the classic, old-school American industries. It's a textbook move away from what's hot and into what has deep, forgotten value.
Okay, so let's start with the biggest tell of all, his massive new bet on housing. This was, by far, the most significant new investment he made. Berkshire bought up big new stakes in the U.S. homebuilders Lennar and D.R. Horton. And this is interesting because it's a sector that, let's be honest, has a lot of people pretty spooked right now. And it's a place Buffett has typically stayed away from when things looked overheated.
So why the heck is he jumping in now? Well, it all comes down to this one little number. These home builders were trading at a price-to-earnings ratio of about 8. So what does that even mean? It's pretty simple, actually. It means you're only paying about $8 for every $1 of profit the company makes in a year. I mean, that is an incredible bargain when a lot of the market is trading for double, even triple that. For a guy like Buffett, a PE that low is like a giant flashing green light.
And you know what? The deal gets even sweeter. When you use valuation models to figure out what a company is really worth based on its future profits, a builder like Lennar was trading at a whopping 50% discount. This is so crucial. Buffett wasn't just buying something because it was cheap, he was buying it with an enormous margin of safety. It's like paying 50 cents for something he's confident is worth a full dollar. But here's the kicker. These companies, they weren't perfect, not by a long shot. I mean, look at Lennar. It passed the test for a cheap valuation, no problem. Its balance sheet was super safe, very little debt, but it failed the high profitability test. And you know what? For Buffett, that was totally fine. He guessed that in an industry like home building, you're just not going to see sky-high margins. That combination of a rock-solid financial footing and a bargain basement price, that was all the convincing he needed.
Okay, so the housing bet was huge, for sure. But it was really just one piece of a much bigger puzzle. This whole strategy of hunting for value where no one else is looking, well, it played out across a bunch of other industries, and it shows a really clear pattern. He's out there looking for diamonds in the rough.
So this quarter, Berkshire also jumped into Nucor, the big steel maker, which looks like a bet on industrial goods. They also picked up Allegion, a really steady security company, and Lamar Advertising, kind of a niche business, but one that spits out consistent cash. But the one that really jumps out is United Health Group. This was a major new position in a healthcare giant, and he started buying after the stock had taken a hit. Some analysts thought it was trading 40, even 70% below its real value. I mean, come on, this is classic, textbook Buffett buying a wonderful business at a wonderful price.
Of course, to make all these new buys, Buffett had to free up some cash. And that brings us to the other side of the equation, the sells. But this wasn't some kind of panic move, not at all. Think of it more like he's carefully pruning his garden, trimming back the things that have grown so big they're starting to get a little risky.
Now, the headline that got everyone talking was, of course, the 7% trim to Berkshire's gigantic stake in Apple. But this chart really puts things in perspective. Even after selling off millions of shares, Apple is still, by a long shot, Berkshire's #1 holding. It's about 22% of the entire portfolio. So let's be clear. This is about taking some chips off the table, not about abandoning the ship.
Okay, so you might be asking, if he still loves Apple, why sell a single share? Well, the why becomes crystal clear when you just look at the numbers. Back in 2016, when he started buying, Apple's PE ratio is a steal at around 10. Today, it's hovering around 30. And look at this, the price-to-book ratio has just exploded from 5 all the way up to almost 50. What's the bottom line? Apple just isn't the screaming bargain it used to be. That huge margin of safety he bought it with is pretty much vanished, so he's doing the smart thing and locking in some of those incredible gains.
And that pruning didn't stop with Apple. Berkshire got out of T-Mobile completely. They also slashed their stake in Charter Communications by nearly half. He's probably worried about their high debt and whether they can still compete. He also took a tiny little 4% trim off his Bank of America position, which just shows he's still being pretty cautious with the whole banking sector.
All right, so let's take a step back. We've seen the buys, we've seen the sells, we've seen him jump into housing and healthcare, while carefully trimming tech and telecom. When you put all of these pieces together, what is this really telling us about how Buffett sees the world right now?
And that brings us to maybe the single most important number in the entire filing. After all that buying and all that selling, Berkshire's cash pile is sitting at a mind-boggling $147 billion. He's just not finding enough of those giant elephant-sized deals he loves to make. He's basically sitting on a mountain of cash, telling the world, I'm patient, I'll wait. It's a huge signal of discipline and caution.
And that leaves us with one big flashing question mark, doesn't it? He's selling what's popular and way too expensive, he's buying what's unloved and dirt cheap, and he's letting his cash hoard grow to historic levels. He is literally living by his most famous advice, being fearful while everyone else is being greedy. So the real question we should all be asking ourselves is, what is he preparing for?
You know, if you want to get a sense of that market temperature yourself, a great tool is the Buffett Indicator app. You can just search for it and download it from the iOS App Store. And hey, if you enjoyed this explainer, we'd love it if you'd like and subscribe to our channel, Deep Value Investing, on Apple, Spotify, or YouTube. We also put a fantastic list of value investing books in the description for you to check out. And just a quick reminder, this is all for educational purposes. Based on public info, it's not investment advice, so please always do your own research. Thanks so much for watching.